This video is an Uncover Japan company research report on Konica Minolta, ticker 4902. The company is best known for office copiers, but the investment story is really about a mature print business funding higher margin materials, optics, and industrial technology. At the report date, Konica Minolta traded on about 9.7 times forward earnings and 0.51 times book value, with a 3.2% dividend yield. That discount reflects a business only just returning to profit. The opportunity is a re-rating if returns improve. The risk is that the market is correctly pricing a structurally slow business. The clearest way to understand Konica Minolta is as two companies stapled together. Digital Workplace supplies printers, consumables, service, and a global installed base. Industry supplies functional display film, sensing instruments, inkjet heads, and semiconductor inspection optics. The first business pays the bills today. The second is where the margin and growth potential sit. The segment chart shows the tension at the heart of the case. Digital Workplace is 56% of sales, but its margin is 6.1%. Industry is only 12% of sales, yet generates a 17.5% margin. That high return unit grew in fiscal 2026, while the legacy businesses were being reshaped. Imaging has improved, but remains the weak link. Revenue has remained above 1 trillion yen for several years, but profits have swung sharply. Large impairments drove a 103 billion yen net loss in fiscal 2023 and a 47 billion yen loss in fiscal 2025. Fiscal 2026 returned to a 30 billion yen profit as one-off charges rolled off and underlying operations improved. That makes repeatable cash generation more informative than any single net income line. Cash flow is the more reassuring part of the account. Operating cash flow rose to 86.2 billion yen in fiscal 2026, and free cash flow was 52.2 billion yen. Free cash flow has stayed positive for 3 straight years. That cash supports growth investment, debt reduction, and the rebuilt dividend, even while accounting earnings have been distorted by restructuring and impairments. The moat is not a blanket defense around the whole company. It lies in two specific places: a global copier service network with recurring revenue, and deeply accumulated know-how in materials, optics, imaging, and microfabrication. Those technologies are now being recombined in niche products for displays and semiconductor inspection. The limitation is equally important. The promising niches are small and sensitive to customer capital spending. Management's corporate plan for 2026 through 2028 is straightforward in principle. Improve the mature print business so it produces cash, reinvest in higher return industry niches, and apply return on invested capital discipline across the portfolio. The target is to move return on equity from 6.1% toward 8% or more. The strategy is coherent, but it still needs evidence of consistent execution. The capital allocation plan explains why free cash flow matters. Over fiscal 2026 to 2028, management expects roughly 230 billion yen of cash inflow. Around 180 billion yen is intended for capital expenditure and investment, including growth investment in industry. Roughly 50 billion yen is allocated to debt reduction and shareholder returns. The company is choosing transformation before full capital return. Among the cited peers, Konica Minolta has the lowest price-to-book valuation at 0.51 times. A low multiple can mean a bargain, but it can also reflect returns that barely clear the cost of capital. The company has stated a 1x book ambition, yet that ambition will only matter if it demonstrates sustained profitability, working capital discipline, and a reduction in impairment risk. The report's own 3-year scenario work spans roughly 470 yen in the bear case, 760 yen in the base case, and 1,050 yen in the bull case, against a 558 yen reference price. These are estimates, not forecasts or recommendations. The variables to watch are practical: whether impairments recur, whether industry profit keeps growing, whether the business contribution margin remains above 4%, and whether return on equity truly rises. Konica Minolta is not simply a copier company, and it is not a completed turnaround. It is a discounted materials and optics business, attempting to convert a mature cash engine into a higher return portfolio. For investors following the story, the two decisive tests are no further major impairments and a credible rise in return on equity. This is research for education, not investment advice. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.